Gentlemen, good day and welcome to the Shankara Building Products Limited Q1 FY2024 Results Conference Call, hosted by ICICI Securities. As a reminder, all participant lines will be in a listen-only mode, and there will be an opportunity for you to ask a question after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your telephone. Please note that this conference is being recorded. I now hand over the call to Mr. Sohail Kaura. Thank you, and you may begin, sir.
Yeah, thank you. Good evening, everyone. On behalf of ICICI Securities Limited, I would like to thank you all for taking the time to join us on the Shankara Building Products Limited Q1 FY2024 Results Conference Call. From the company's leadership team, we have with us Mr. Sukumar Srinivas, Managing Director, Mr. C. Ravi Kumar, Executive Director, Mr. Alex Varghese, CFO, Mr. Dhananjay Mirle Srinivas, VP Business Development, and Mr. Giridhar Parthasarathy, Manager Accounts and Finance. We will open the call with the opening remarks from the management, followed by a Q&A session. I would now like to hand over the call to Mr. Dhananjay Mirle Srinivas, Vice President, Business Development and Head of Non-Steel at Shankara Building Products Limited, to make the opening remarks. Over to you, sir.
Good afternoon, everyone. A very warm welcome to Shankara Building Products Limited Q1 FY 2024 earnings call. I have with me Mr. Sukumar Srinivas, our Managing Director, Mr. C. Ravi Kumar, our Executive Director, Mr. Alex Varghese, our CFO, and Mr. Giridhar Parthasarathy, our Manager Accounts and Finance. I hope you would have all had an opportunity to go through our quarterly presentation uploaded on the stock exchange websites. I will initiate the call by taking you through the business updates during Q1 FY2024. After this, Alex Varghese will share an update on the financial performance during the quarter. Despite the challenging macroeconomic environment, we are happy to have delivered another quarter of resilient performance. The residential real estate activity is witnessing its decadal high, while commercial real estate activity is making a strong recovery with resumption in work from office. The pandemic has induced desire for larger and premium houses, which has augmented significant surge in demand for the home improvement industry. Additionally, the overall improvement in construction activities, continuous investment in infrastructure and policy support by the government is also posing an opportunity for the building materials and home improvement industry. As we are evolving on our journey to Shankara 2.0, our primary focus over the past few quarters has been towards aligning our product offerings and our omni-channel presence according to the evolving needs of the real estate market. From our legacy of a steel trading company, we have progressed to become a one-stop omni-channel marketplace for building materials. Today, we have around 1 lakh plus SKUs across the product categories and brands. We have expanded our infrastructure to 125 fulfillment centers, which includes our 90 plus retail stores. And now, we have a push towards an online presence through our BuildPro app and website. This has helped us to provide a tailored solution and cater to the increased activities in the home improvement industry. As we stand today, we are not just well positioned to capitalize on the favorable real estate cycle, but also to a significant market share expansion opportunity within the sub-segments we're operating in. Especially in our non-steel business, we intend to grow much more aggressively in the coming years. We have internally set our aspiration to grow our non-steel vertical from around 10% presently to 25% of our revenues in the next 4 to 5 years. To achieve this, we have been continuously refurbishing our existing fulfillment centers to bring in more non-steel products. The strategic aim is to increase cross-selling opportunities at all our fulfillment centers and at the same time leveraging our existing customer relationships as we expand our range of products and brands both in steel and non-steel categories. Our exclusive ultra-luxury displays in Bangalore and Chennai offer superior brands and specialty products, which is also witnessing a significant response from our premium customers. We have also recently introduced a concept of store-in-store. We started this with Asia's and the world's largest paint company, Nippon Paints, and we have already introduced 2 such stores within our existing network. We are working with them for setting up another 4 to 5 such stores in the coming months. We also intend to introduce this with our other brands in the coming years. The testament of all of this is an increasing ticket size and the number of transactions at our fulfillment centers. Our retail business continues to perform well with the same-store sales growth of 31% year-on-year during the quarter. Recently, we have added 5 new stores, 1 in Gujarat, 2 in Tamil Nadu, and 2 in Kerala. We have also rationalized a few of our stores, 3 in Karnataka, 1 in Andhra Pradesh, and 1 in Tamil Nadu, keeping our net store count at a similar level. At 91, over the years, we realized that our customer base in these regions could be serviced from our alternative stores in the same region. So, we have strategically closed these stores and leased some extra space in the nearby stores in the same region. And hence, closure of these stores is unlikely to make any impact to our revenues and will indeed result in savings in administrative cost of handling an extra store. We also have 2 new fulfillment centers under pipeline coming in Maharashtra and Madhya Pradesh. Given our well-established presence in the south, we continue our strategy towards a cluster-based growth approach and continuously strengthening our penetration in the southern region while gradually expanding to other states such as Maharashtra and Madhya Pradesh. Simultaneously, we are also growing our digital presence. Given the nature of the building material industry, customers prefer visiting offline stores after conducting online research. Thus, we have used technology as a mode to capture more customers. Customers use our platform to do their preliminary research on products and are encouraged to visit the stores to get a live experience. This is driving increased walk-ins in our stores and consequently improvement in our same-store sales growth. Further, customers who are looking for a single product online end up buying multiple products at our centers. For example, a customer can purchase a soap rack or a towel holder and other bathroom-related accessories which they originally didn't envisage in our stores. Hence, while our revenue digital platform is not substantial at the moment, we intend to promote it extensively and expand to other regions in the coming years. We have been popularizing our Shankara Build Pro app among influencers and customers during our influencers and customer meets as a platform where the range of products offered can be browsed through. We are also gradually upgrading our online platform, which is presently limited to certain non-steel items, to make it more suitable for bulkier products as well. With this, I would like to hand over the call to Mr. Alex, who will be sharing an update on the financial performance with you. Thank you.
Thank you. Good afternoon, everyone. I hope all of you are doing well. We are happy to announce another quarter of strong and resilient performance. Our total revenue for the quarter stood at rupees 1,132 crores, registered a 36% year-on-year growth from rupees 833 crores in the corresponding quarter previous year. Our EBITDA for the quarter stood at 34.5 crores, up by 30% year-on-year. Our EBITDA margin have improved sequentially by 6 basis points to 3.04% compared to 2.98% in Q4 FY23. However, on a year-on-year basis, our EBITDA margin were down by 14 basis points, primarily on account of steel price softening, which resulted in some inventory losses during the quarter. However, the steel prices have started stabilizing this quarter. Nevertheless, against a 36% year-on-year revenue growth, our finance cost has increased by just 17% year-on-year during the quarter, led by our significant focus on keeping our working capital requirement under control. This has resulted in a substantial improvement in our net profit by 44% year-on-year to rupees 17.3 crores compared to the rupees 12 crores during Q1 FY23. Our working capital days continues to stand comfortably at sub 30 days during the quarter compared to 44 days during Q1 FY23. Consequently, our cash flow from operation also stands positive as against negative cash flow from operation during the corresponding quarter in the previous year. As far as the segmental performance is considered, our retail segment reported a revenue of rupees 631 crores, up by 31% year-on-year, while our EBITDA for the segment was up by 18% year-on-year during the quarter. With the same store base, we have been able to achieve a 20% year-on-year growth in the number of transactions and 10% year-on-year growth on average ticket size per transaction, primarily led by newer products and categories at our existing center across steel and non-steel products. While we grow our retail business, we are focused to keep our costs under control for the segment, and hence, while our revenues are up by 31% year-on-year, our rental cost just has grown by 5% on year-on-year. As far as non-steel segment is concerned, non-retail segment is concerned, comprising our channel and enterprise business, have grown by 43% year-on-year during the quarter at rupees 501 crores. Despite steel prices softening, EBITDA for our non-retail business was up by 21% year-on-year to rupees 7.9 crores. Given the limited margin in the segment, we are exercising significant control over our costs, which has supported the EBITDA improvement in this segment. We expect our revenue growth momentum to continue in the coming quarters. While we grow our revenues, we are also committed to slightly improve our profitability margin from the current levels and keep our working capital cycle under control to remain capital efficient. We are focusing towards grow our non-steel business, which is more value adding than our steel business. Hence, as we grow our non-steel vertical, our blended EBITDA margin are expected to improve. While we strive to grow our top line and profitability, we also aim to keep a capital efficient balance sheet with our asset-light model for retail store expansion and efficient working capital management measures, such as ensuring credit availability from suppliers and improving our supply chain to be able to optimize our inventory levels. Our collective effort on revenue and profitability, along with our lean balance sheet approach, should drive improvement in return indicators for our company and the investors in the coming quarters and years. With this, we will open the forum for question and answers.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. Our first question is from Kaustav from Retail Investor. Please proceed.
Hey, hi. I just wanted to ask one thing. Is there a demand slowdown that you have seen in this particular quarter? Because I see from the previous quarter, this has came down. Like the March quarter, the revenue was a bit higher, but this quarter, the revenue is slightly lower. I tried to see if there's a similar pattern last year, but last year I saw that there was an increase in the June quarter vis-a-vis the March quarter. So was there a demand slowdown that you guys have seen? And secondly, I guess like your retail revenue grew a slightly bit slower than your non-retail side of business. So could you please elaborate on it? And is there a possibility that we can increase it by any chance? Because I guess since there is like a lot of people are already improving their homes, is there a possibility that you open stores and try to drive it forward, like the growth? Yeah, these are my two questions.
Hello. Thank you for your question. So I'll answer the first part. So usually what we see in the building material industry is that Q4 is substantially heavier quarter, higher in terms of volume and sales. So subsequently, Q1 would always look a little lower.
Okay.
That is number one. Point number two, I think normally in this industry, towards the end of the quarter one, there is also monsoons that hit many parts of the country. So particularly in the south, Kerala is impacted. We have impacts in parts of Karnataka. We have an impact in parts of Maharashtra. So I think generally Q1 is always a slower quarter for many in industry. That does not mean that we should not grow on Q1 compared to Q4. So I think generally the last couple of quarters in any in the real estate and building industry is a much more heavier. There's a much more buying, and particularly when we look at steel, etc. Towards the last quarter, there's a lot of projects that get completed. There are schedules. When we also supply to various contracts, there is a schedule for completion by March 31st. So this is a general tendency we have seen over the years.
Okay. And if you could answer the second question, please.
Could you just repeat the second part, please?
Yeah. So basically, the second question was, I see that your retail growth is slightly bit slower, but I guess maybe that is something that is answered by what you said in the first question. Another thing that I wanted to understand was, is there a possibility that when the government is doing a lot of infrastructure works, you guys are providing to the EPC manufacturers, will the infra push kind of help you in any way? Can you throw some light on it?
I think as you say, with government focusing on infrastructure growth, the policies help everyone in the building material industry. And since we have a very negligible direct supply to government projects, we could...
Definitely, I think government spending on infrastructure helps, and it has a direct impact on our growth.
Okay. Got it. And one last question from my end. So, by Q4, at what EBITDA percentage do you want to close the business around? I know you have guided for some improvement in the margins, but do you have a number in mind that you would be aspiring to reach by the end of Q4?
Yeah, I think we are, as we have guided earlier also, we are currently around the 3%. We have guided that probably about a half a percentage point, basis point, is what we are guiding towards the end of the year.
Okay, understood. Yeah, I will return back to the queue. Thank you.
Thank you. Anyone who wishes to ask a question, please press star and 1 on your touchtone telephone. Our next question is from Maulik Patel with Aquarius. Please proceed.
Thanks for the opportunity. It's good to see the performance after long. Sukumar, a couple of questions. One is basically, I think in the past we discussed about the two initiatives. One is that a non-steel portion of the revenue, which was around 25% a couple of years back, where it has reached right now, and what kind of traction you have seen, because in which particular category there is a more traction for you?
Maulik, I think you'll have to be a little louder.
No, I will just repeat it. Yeah, regarding this non-steel revenue, I think earlier it used to be around 25% of our revenue. Now currently...
No. See, that was in the retail. There was also roofing segment that was coming in the retail part. Now what we have done is roofing is also largely steel-based. So that though it's sold as a product, now we are categorizing it very clearly as steel.
Okay.
So I think today about 10% is the absolute non-steel, which includes bathrooms, it includes city sanitary, etc. flooring, tiles, electricals, and so on.
Okay, got it. And what proportion of revenue you want to be seeing a couple of years down the line, and what kind of efforts and what exactly we are doing to increase that revenue base?
Yeah, one is, I think broadly we are looking at in the next 4 to 5 years that 25% total revenue should come from the non-steel part. Number one. Number two, you asked what kind of efforts that we're doing. So I think the sheer fact that in the last 2 years, I think Dhananjay is heading the non-steel exclusively. So I think he has also driven a considerable amount of momentum. And so that is number one. The management structure for the non-steel has been extremely structured. We have taken a lot of people from the industry. So I think that is number one. There are a lot of vertical heads, so which is another. So the entire management broadly has been strengthened in terms of the non-steel part of the business. So I think these two itself are yielding a lot of positive results. I think a lot of depth and a lot of expansion of territory, etc., has happened. So in the earlier years, when we were about 3 to 4 years, I think our non-steel was largely restricted to Chennai and Bangalore. Today, we have got a substantial presence in Kerala. We have opened an office in Morbi now, and I think we're expanding that. We've also started our own in-house branding of tiles. So we are just in the process of opening a depot and a display center in Morbi. So I think we are planning, as I think it was mentioned in the earlier speech, we're opening an entire fulfillment center in Maharashtra for tiles. So I think there is a lot of growth and a lot of push that we are seeing. So there is a considerable amount of effort that is happening in the promotion of non-steel. And also, as mentioned in the overall presentation, we talked about non-steel being the focus of the company. So I think that itself should probably broadly answer your question.
Sure. I got it. So currently, if you look at the steel has a gross margin of around 9 to 10%. It used to be, right, in the past, and the non-steel will have a much higher gross margin or the similar range?
Boss, steel never had 9 to 10% in the past. I think somewhere that was a non-steel kind of a margin we were talking about. Steel in the past used to have around 5%, which has now actually slightly come down. I mean, maybe it was 5 to 6% in the early days, about 6-7 years ago. I think now it has come down to around 4%. So when we are looking at the gross in terms of the non-steel, what is the number? I think it's about 10-odd% today, and 8 to 10% today in the gross margins of the non-steel part.
Then currently, if I look at the financial, your gross margin is close to around 9%, right, for this financial and this quarter? And because you mentioned that it's only 10% of my business is in non-steel, and that have so this doesn't include the manufacturing margin, which you still have some assets on the manufacturing.
Only can you tell where the gross margin of 9% you have seen? Because nowhere the gross margin has shown as 9%.
Oh, sorry. Okay. My mistake. I was looking at some other number. So currently the gross margin is around 5%, right? 5 to 6%.
Yeah, 5.5 to 6.
Yeah, I was looking at some other number. Okay. And third element, I think you mentioned about this omni-channel. Can you tell us how much of percentage of revenue comes from this particular initiative of the omni-channel?
If you say omni-channel, we are talking about customers walking into our stores, calling us, using our online platform as a discovery. So I think omni-channel...
Maulik, I'll just intervene here. If you remember, a year ago we announced a sort of a slight differentiation in our model, what we call the Shankara version 2.0. So earlier we were very clearly delineated with the retail and the non-retail part. So now we are looking at, we were calling that non-retail, we're calling it the channel and the enterprise part. So there was a lot of confusion on the same. So we started looking at more to align ourselves with the marketplace, where it started looking more and more obvious that this marketplace model was coming in and was probably here to stay. So when we define omni-channel, we are looking at multiple channels. So omni-channel is digital. It is the existing way of selling. It could be the walk-in to the retail store. It is through it's through telephone. It can be any. We are just basing the entire definition of marketing rather than restricting it to 2 or 3 traditional definitions.
Okay, got it. And what's the debt on the books currently, including the acceptance? And I can see that working capital has been brought down significantly over the last 2-3 years, particularly post-COVID. Now we are about at 25 net working capital days. But what's the overall debt structure on the books, including acceptance?
Yeah, acceptance also are there in the payable, which is coming approximately around 250 crores.
250 crores. And this 250 crores plus there will be some normal debt on the books, right? Borrowings from the bank.
Around 80 crores.
So it's around 330 crore rupees currently. Okay, got it. Thanks, Sukumar. Thanks, Dhananjay. Thanks, Alex.
Yes, Malik. Pleasure talking to you as always.
Thank you.
Same here.
Thank you. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question is from Deepak Podar from Sapphire Capital. Please proceed.
Hello.
Yes.
Yeah, thank you very much, sir, for the opportunity. So first up, just a clarification. You did mention, right, our 3% is the EBITDA margin right now, and we are targeting 3.5% by FY2024 end, right?
Correct.
Okay, understood. And in terms of your growth, I mean, we have spoken earlier as well, we are looking at maybe 25 to 30% top line growth this year, right? So just wanted to understand in terms of retail and enterprise, how do we see the growth segment-wise?
It will be similar. Retail and enterprise will be similar growth.
Oh, so the same range will apply to both the segment, right?
Yeah.
Okay, understood. And in terms of, aspirational margin, if we exit at 3.5%, what sort of steady state margin we might be looking at, maybe 1 to 2 years down the line?
Will be approximately around the 4%.
So your voice was not audible, sir.
Yeah, aspiration is go up to 4%.
4%.
Yeah.
Okay, understood. Yep, that's it from my side, sir. All the very best. Thank you so much.
Thank you. Our next question is from Aditya, an individual investor. Please proceed.
Thank you for the opportunity, sir. Sir, can you please throw some light on our digital business, where we are today and where do we see ourselves 2-3 years down the line, and what contribution we can expect to the overall revenue in 2-3 years?
So, as we said in the earnings call, our digital platform is currently, we use it as a discovery platform because, as you know, in the building material industry, still it takes some time for people to buy bulky, large, expensive products with high ticket value online. So we are working towards increasing our cataloging, increasing our product offering and range online. We're also working to increase the number of people purchasing online. It would be difficult to give a number because, as we said, a lot of it are customers looking for single products where we try to bring them into our stores. We do want to increase the walk-ins and use it as a discovery platform. So for the time being, we are working to expand and increase on this. The exact revenue would be...
Just to add to what Dhananjay is saying, we also have plans that, in the near future, we should also start, get on to other marketplaces if possible. So we are working on that. So if that marketplace, using other well-established marketplace, if that starts happening, I can comfortably say that at least our aspiration in the next 3 years would be to target about probably to some level to have a significant percentage of our sales in terms of at least a high single-digit number should go through this marketplace, through the digital online platform.
Okay, fair enough, sir. Thank you so much. I'll get back into you.
Thank you. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question is for Soumitra Joshi with HNI. Please proceed. Ms. Joshi, we are not able to hear you. Request you to please come back into the queue. Ladies and gentlemen, our next question is from Neeraj Lal with KCC Advisors. Please proceed.
Hello, sir. Good evening, and congratulations on the good set of numbers. Sir, I just have a couple of questions. One is I just wanted to get an idea of the online channel which we are doing, and just an update on the Shankara Build Pro app. Could you please share any details around this? It will be helpful.
So, for online, as we just said earlier, our idea and our plan currently what customers use our online platform is for a preliminary research. We are encouraging more customers to come online to come to our stores to get the live experience. Our focus is to grow, as I said, by adding more categories, adding more products, and kind of making it more comprehensive. We are working on adding more cataloging. So currently the online platform is a discovery tool. It is a marketing tool as well for customers to find out where our stores are, where we are. And we are also trying to capture the data of customers who come online so then we can follow up with them and bring them to our stores. The app, it works more for our influencers and our regular customers who can keep a track of their purchases and who can also focus on looking for other products and plan the next stage of their building life cycle. We are also looking that we also know that while the revenue from our digital platform is not substantial, we do intend to promote it extensively and expand it to other regions and locations. We also have customers who come for single products and would then have a bigger spending in our stores. And as I said, it's about getting the experience from the stores because a lot of products do need a touch and feel in building materials. I hope that answered your question.
Sure, sir. That is helpful. But in terms of like expansion,
Yes.
Barring South, are we planning to go to Pan India, or what are our plans on that end?
Our aspiration is to go Pan India. Currently, we are utilizing our 125 fulfillment centers to cater to customers. But as we find there's still a lot of potential in the South, and we have a cluster-based approach for our growth. So we are, as we grow step by step in the future, definitely we are hoping to go Pan India.
Okay, makes sense. And in that case, what will be our key products in our non-steel business, sir?
Currently, the key products of our non-steel is between the CP fittings and sanitary ware, plumbing items, and tiles. And going forward, we do see now a big pickup in paints as well with our strategic tie-up with Nippon. And while currently 46% of our revenue is from sanitary ware and plumbing, and in the non-steel. And the whole idea is that we have a lot more verticals which we are exploring and adding year on year, which we see a lot of potential and growth going forward. Our strategy is to focus on the sub-segment and then move to the next as you achieve a modest size in the earlier sub-segment.
Okay, sure, sir. That was helpful. So just one last question. Just wanted to understand, like, what will be our criteria or metrics or, let's say, parameters for closing the store? In case if we are looking into, like, what will be the parameters for that?
So, initially, and most of the stores where we did close, we had the rationale where we found it as a strategic advantage. So we found that we could cater to the existing customer base from a nearby store or fulfillment center. So it was more of we are being able to not basically the factors influencing our decision making is possibly limiting of the growth. Maybe the store size was small. Sometimes we do have a few local or regional issues. So it's more of a consolidation rather than closing down. And by having extra space in the existing stores, we are able to cater to, and it doesn't impact our revenues as well. We've had a negligible impact from closing energy stores. We are able to cater to the customers from the nearby.
Sure, sir. That was helpful. I'll get back to the queue in case of additional questions. Thank you, sir. Thank you.
Thank you. Anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question is from Kaustav, a retail investor. Please proceed.
Hi for giving the opportunity again. I just wanted to follow up with a couple of more questions. So I just understood that you guys are launching your own brands under your own label. What is the kind of margin profile on that? Can you just help me with that?
So since we've just launched the private label, we're still in a very nascent and growing stage. So currently, since we are looking to increase the market share and grow, I would say the margins would be at an 8 to 10%.
Got it. Okay. One more thing. So you have an aspirational number of reaching 25% non-steel revenue. So when you reach the target, what can be the EBITDA range? Like right now, it is around 3%, and you have an expectation of reaching to 3.5 by the end of this year. I mean, end of this financial year. What is the expectation when you reach 25% of your revenue from non-steel? EBITDA percentage.
So when we get to 25%, we hope that aiming that our EBITDA will be around 5%.
Okay, got it. Okay, and so basically, once you reach the 25% mark, there is nothing stopping you to go even higher, right? So I'm just thinking from a very long point of view, like 7 to 8 years down the line, would you be trying to push like these your own brands, own labels, sanitary wares, paints, as these might be more profitable? So would you be trying to increase that 25% to a higher amount? Like I'm not talking about 4-5 years. I'm talking about a longer horizon, like 8 to 10 years kind of a horizon. I'm trying to understand how the company will look like that point of time.
So as you said, when we get to the 25%, we would be very substantial for all our brands. We believe that we can grow with our brands, and we don't necessarily require private labels in all categories. We will be continuing private labels in tiles, but as of now, we do not have any plans for private labels in any of the other categories. I think we just have to take it as we go, especially after we get to the 25% to see how the market is at that time. And as you said, there is potential, as always, but I think we're growing with our principals currently, so we do want to keep the growth with them and not necessarily branch out on our own.
Okay, one last thing. I'm not sure if the management has thought about this, but I was just trying to see your website, and it is really good. So is there a possibility that you can also provide some interior designing solutions, like maybe if you guys could foray into that, that might be another vertical which might, which will be allied to your business and might increase your...
It's a great idea, and we do have that in mind, but I think we're just right now trying to consolidate our platform, and we will go in segment-wise. We will be coming to this, and I could say that in the future we will have something like this. We have thought about it, and it's a great suggestion as well from you. I think you will see more of this in the future.
Okay. Thanks a lot, and have a great journey ahead. Thank you.
Thank you. You too.
Thank you. Anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question is from Guneet from CCIPL. Please proceed.
Thank you for giving me this opportunity. I just want to understand what is the outlook for FY24 in terms of top line and bottom line. I'm sorry if I missed it previously. And you said that we are at 3% margins currently, but expecting to reach around 3.5 margins by the end of the year. So, I mean, on an annual basis, what kind of margins can we expect for FY24?
So we are starting to grow our revenue at 20 to 30% CAGR over the next 4 to 5 years. And you could say, what would we say? We aspire to become a 10,000 crore top line company in the next 5 years.
All right. So, I mean, looking at the current market conditions, do you think we are on track to deliver 20 to 30% growth in FY24 as well?
Yes, we think there is great potential in the market. We are still, especially in the non-steel, just at a very nascent stage. There is a lot more push from the management also to grow aggressively. So we do believe it's possible.
All right. And what gives you this confidence? I mean, looking at the demand in the market, or what is giving you confidence to grow at such a nice rate?
Sorry, can you repeat? Sorry, I just lost you there. Could you please repeat the question?
I just want to understand, I mean, what is giving you the confidence to grow at 20 to 30% CAGR, and even this year at 20 to 30% rate? So is it like the conditions you see in the market, or, I mean, can you just elaborate on that?
Yeah, I think basically building industry, the building industry itself is such an overarching kind of a base for any country. So if you look at really the overall potential, we are talking of lakhs and lakhs of crores in terms of rupees. So I think if you take even single segments, let's say PPM sanitary, we are looking at close to something like 20 to 30,000 crores as a potential per annum. Today we are currently at about 250 crores. So if I just double that or triple that over the next 4 to 5 years, this single segment itself can give us 750 to 1,000 crores. If we take the flooring and the tiles specific industry, we are looking at 30 to 40,000 crores. Again, there we are at around 200 crores today. So even if we double, triple that, we are at these kind of numbers. Steel itself, if you look at as a segment, is growing at close to 8% per annum. So, and we've got a lot of infrastructure. You know how India is in terms of our urban infrastructure. We are talking of humongous investments in railways. We are talking of investments in airports, investments in ports. So I think if you look at it combinedly, the potential as such is absolutely, unlimited as far as India grows. There have been statements by Morgan Stanley saying that India is at an inflection stage now, where we're looking at probably a 10% runaway growth, irrespective of who the government is, and so on. So I think, and as you know, optimism and hope springs eternal. So I think based on all these facts, we do aspire and we do see that if we carry out things correctly, this kind of growth momentum can be maintained.
Got it. That is very heartening. And in terms of the margins, do you expect them to improve quarter on quarter as we move forward? I mean, looking at the condition in Q2 right now and for the rest of the year, do we expect the margins to improve?
Yes, of course. We have been, any organization aspires to have its profitability growing. Definitely, we are at the current 2.5% that we have been doing in the steel broadly, and the the non-steel EBITDA is around 5.5 to 6. Currently, as the non-steel increases the share in the overall volume and the overall business, I think the EBITDA overall will also start improving.
All right. So what are your projections for FY24 in terms of non-steel revenue? As percentage of total revenue.
For the year, we are looking at close to around 500 crores for the year.
All right. That is great. Thank you very much for the opportunity and all the best.
Thank you.
Thank you. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question is from Suryansh with BizX Enterprise LLP. Please proceed.
Congratulations on good set of number. What I need to ask is that, we all are aware that it's the size of the market is very huge, and we all know that most of the market is unorganized. But what we are doing differently to get the customers or whoever holds the decision to buy these products, architect or plumber, carpenter. So how we are making sure that we are, in terms of providing, what we are doing differently that customers land to our store and not at other channels.
So in India and in the South and how it is, as you said, influencers are very key to as you say, influence the buying habits of customers. in building materials, architects and contractors. A lot of customers do listen to them for their technical aspect and design. So we do work substantially on working with architects, plumbers, contractors, and end customers as well. We have regular plumber meets in all our showrooms where we cater to what the needs of the plumber are and how we can service them better. We have a separate team that works on architects and interior designers who take care of them, who bring them to the showroom, who help them in selection, help them in bringing brands, and also make it easy for them to reach customers. The large number of stores which we have also helps us cater to customers in all territories. We also use our technology and our online platform to get customers and to market ourselves. So you do reach end customers. We also use it to capture more customers and customers also use our platform to do their preliminary research on products, and so they are encouraged to visit our stores to get a live experience, which also drives an increase in the walk-in. And our brand building and the fact that we are a listed company also instills trust in the customers. They know that we have genuine products at good prices and we do offer great service. So I think these all put together along with the practice are going to make sure that influencers, architects and other decision makers are comfortable, who are aware, and honestly the number of brands we have helps them really cater to their role requirements from the beginning of the building material life cycle to the end.
Okay, and one more question was that credit decision is one of the significant decision in terms of buying. Like these are very high value in nature. So, are we tying up with companies, financial companies, to provide those credit? Are we doing those things?
Yeah, which we are doing it with a few banks. We are doing it. So we are getting the channel finance type of limits we are getting from various banks, which we are enjoying. Currently, if you are asking if the question is directed to individual homes where you tie up with NBFCs for their home improvement loans, etc., we have not yet tied up with banks for that particular purpose. This is something we are exploring, and we hope that maybe in the next year or so, we should slowly start tying up with financial companies to help provide credit to the individual customers.
Okay. Thanks. That's all from my side. Thank you.
Thank you. Anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question is from Kaustav, a retail investor. Please proceed.
Hi, just thanks for letting me ask this question again. So just one more thing I wanted to understand. So couple of quarters ago, I guess you gave a guidance of reaching around 10,000 crores. Like an aspirational number, 10,000 crores in 4 to 5 years. And now I see that you have given a margin guidance, like an aspirational margin guidance of reaching 5% EBITDA margin by the same time, like when you reach 25% of your non-steel, 25% non-steel revenue. So what I wanted to ask is, if you could just compute the numbers, it looks like that by 4 to 5 years, you guys are expecting around 4 to 4.5 of the current EBITDA. So basically 4 to 5 times of current EBITDA. Am I missing something in this, or is this the growth that you guys are internally calculating also?
Yes.
Okay. Yeah. That is all actually. That is what I wanted to understand.
Thank you. Anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question is from A. Ravind, an individual investor. Please proceed.
Hello, am I audible?
Yes.
Yeah, hi. So thanks for the opportunity and congratulations on the good set of numbers. I have 2 questions. One is with respect to the tiles brand, the private.
Sorry, could you just speak a little louder? We're not able to hear you.
Is it better now?
Yes, much better.
Okay. So I just like to understand the rationale for going with the private label tiles brand, right? Because tiles is more of a commodity industry and very few players have the the brand power or strength, right? And what was the rationale behind getting into our own brand, considering the market situation, number one. And number two, considering the influencers are a major stakeholder in the purchase decision, do we have any loyalty program for them, or do we plan to introduce it in the future? Thanks.
So I would say tiles is more than a commodity. Tiles is almost like sari shopping, where customers require thousands and thousands of designs, and everyone has different taste. So I do feel, and we do believe as a management, that the tile industry has a lot of potential. We have tied up with multiple factories. We are producing our own tiles in different sizes and varieties and designs, and we are able to bring out these designs faster to market than some traditional players because we have limited R&D. I would also say that our presence is very strong in the south, so we feel that we already have a good customer base which we would like to bring with our own products, and we have more flexibility in designs, and tiles really is, I would say, more than just a commodity nowadays. And for the second part of the question, we are planning to come out with something for the loyalty programs. We will keep you posted when we do.
Okay. So have we seen any initial success with the tiles launch, or still initial stages today?
We currently do around 100 plus crores in our private label per year. And so we definitely have seen some limited success in that.
Okay.
And that's last year.
Last year. Okay. Okay. Thank you, all the best.
Thank you. Our next question is from Aditya, an individual investor. Please proceed.
Thank you for taking my question. So, sir, I was going through the annual top line of a company. So from 2014 till 2022, we were in the range of 2,000 crores to 2,500 odd crores. But last year we exceeded, in FY23, we exceeded 4,000 crores. And now we are confident about achieving 10,000 crores in next 5 years. So, which is about 17-18% top line growth. So I just wanted to understand, is this because of the industry, or you guys have reworked on the strategy? This is my first question. And my second question is, at 10,000 crore top line, what will be our aspirational revenue mix, like channel business versus retail? If you can throw some light on this as well. Thank you.
I think the 2-3 years of stagnation that you're quoting, that is, say, from 2019 to about 22, I think one of the key reasons in that period was COVID. So we did slow down considerably in that period. We sort of were very focused on working capital and balance sheet management. I think last year and the year, that is 22-23, the management took a clear call that we need to up our ante as far as top-line growth because of the following reasons. One, I think the market scenario itself had changed considerably. There were a number of new players in the market space, in the marketplace model, and I think overall competition was revving up, so we had to really take a call about substantially increasing our top line. That is number one. Number two, as far as when we are looking at the next 4 to 5 years, when we are having an aspirational top line revenue of around 10,000 crores, what was the real bifurcation that you wanted there?
The channel business versus retail business or any digital business.
Yeah, sorry, I got it. Sorry, my mistake. I think the thought process is that we are converting our entire model more into a marketplace model. So definitely the retail, the 90 stores probably would have grown also by then. But however, the retail is going to get subsumed in this marketplace model. So probably if you're looking at it in the same basis, today we are at about 50-50 or 55 is retail and about 45 is the channel and enterprise. We would like to, within the overall concept of marketplace, probably it would be around the same. And however, in that period, in the next 4 to 5 years, we also hope to have grown substantially in the digital presence.
Okay, sir. So will we need any sort of borrowings to increase our top line or any sort of capex or something?
See, capex we are looking at broadly from the perspective of warehousing, etc. So we are looking at broadly, this is just a sort of a ballpark figure of around 30 crores per annum. That is something like what we are looking at. the capex part. And in terms of borrowing, and there may be a marginal plus or minus. We would largely fund and see that we can sustain on the current level. But as the revenue substantially increase, I think our CFO can keep you posted on that subsequently.
Okay. Thank you so much, sir. Thank you so much.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you, everyone, for taking the time out to attend our earnings call today. I hope you all have a good day. Thank you very much.
On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.